Hello, fellow investors. Welcome to Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Charles Carillo. Charles is a managing partner at Harborside Partners, a real estate syndication firm, and has been actively investing in multifamily real estate since 2006. Charles also hosts the Global Investor Podcast, where he interviews professionals about investing in U.S. real estate. Charles, thanks for being on the show today.
Thanks for having me, Kent. It's great to be here.
Yeah, awesome. I can't wait to dig into some of these points. So to start off, help our listeners know a little bit more about you. Tell us about your background and what brought you into real estate investing.
So I grew up in real estate investing. I'm originally from Connecticut. I moved down to Florida in 2012. And my father had been a multifamily investor since the 80s. Multifamily, mixed use, not really too many 100% commercial buildings, but mixed use was another thing that he was into. And mixed use is really just if you're in a city center and you have some commercial, whether it's office or retail on the first floor, and then you have a residential on top. And I would say 75 to 90% of the building square footage wise is probably residential. And then you have a small little commercial print on the bottom there. So that's kind of what he was interested in and what he was doing. And I didn't really like it getting into it like with him, and not like I was involved with it when I was in like elementary school, but it was something that he brought me. It would be like twice a week, and we go and do property management. And he self-managed them. He had a team, and it was like 100 plus units. And he had one partner, and that was about it for some of the properties. And some of them he owned 100% out, no syndication. And it was just kind of going around talking to superintendents, talking to contractors, running up the stairs to get rent, running down to his car, to his work van to get receipts and run them back up, and 3 floors down, 3 floors up, and all that kind of stuff. And the properties that he was in, the majority of them unit wise was like, I would say like D, C minus kind of stuff, right? So as somebody coming from the suburbs, it's not a sexy thing that you want to get involved with when you're younger. It's not kind of what your plans are. But when I got out of college and my dad was really pushing me to buy my first property, and he just made sure that we were buying in better areas, and he started buying in better areas as he kind of became more seasoned in the industry. And but when we went in, we didn't buy anything. And I don't buy anything now that's less than C plus, or maybe if it's C, if it's gentrification. But it's something that I'll never go below that. When I ever hear somebody going, no, C minus, especially on their first couple properties, because there are some successful landlords that can manage C minus and below. It's not something that it's a whole different management. You can manage a C plus and you can manage a B property, and they're pretty similar, right? But when you're going down to D, it's a completely different demographic than a C plus property, like hands off, completely different. And so that was something when I started buying property in 2006, it was multifamily. And then in 2009, I bought my first, it was a mixed use commercial property, which I still own both of those today. And then I started buying some smaller multifamily throughout that time as well. And I self-managed for 6 years. And in 2012, moved to Florida. I had to get professional management, which is something I never did before, or my dad ever did before. But I found a great property manager through a contact I had from actually the first property we bought. The seller gave me an awesome, you keep in contact, and it's awesome about networking and relationships. And I've had that management company for 9 years. I've been blessed. They're a great company. And I handle my kind of remote asset management from there. And during COVID, I haven't been able to be up there. So I haven't actually seen the properties in like 2 years, but I usually would go up probably twice a year to check on that small little portfolio. And now we syndicate properties mainly through Florida and the whole Southeast.
Gotcha. Well, that's sounds like an awesome experience. I mean, maybe not in the moment being a little kid and being drug around to the properties, but I think just being able to grow up in that environment and understand the power of real estate, right? And the way that it was able to generate wealth for your family, and see that firsthand and get that experience sounds like great exposure. So how did that really influence your perspective on investing?
It went to show, because I always asked my dad. I wasn't really into real estate, and for better or worse, I read after 7th grade that summer before 8th grade, I read Art of the Deal by Donald Trump. And I was like, all right, this
Mhm.
is exactly what I'm doing. And this is maybe like in the late 90s. And I was like, oh, this is the best thing ever. And I asked my dad, like, why don't you have it managed? Like, why don't you get third party management? Why you do it like for growing it? My dad's like, gosh, this, that. And he had all those different reasons for what worked for him. And I think, he was more of a mom and pop operator. And, as we would say today. And it was just, he had a system that worked and he had superintendents that worked. And I think that to get into the next level when I was doing it, because I was continuing on that path when I started. And I was like,
Mhm.
oh, I had this, I had an online business that my brother runs now full time. And we're like, okay, make money. We'll invest in real estate, make money, invest in real estate. And and then it was like, okay, I think the only way of really growing this is to get into syndication. And we would invest passively to kind of see how it was. And then actively start doing deals. And I still passively invest now. I mean, the majority of what we're investing into is deals that we're general partner and active investing on. But it's a whole different mindset, because real estate, really, no matter where you get involved with it, if you're on the active side, whether you have it a property management company or not, it's not really 100% passive. And the only way of it really being 100% passive, I have found, is going through and doing REITs and stuff like that, or going through the syndication passive model, which is one of my favorite. And I always tell people, if I really didn't love real estate, I would just do the passive side of it and never even get into the active, because it's so nice when you're just getting money that hits your account every month or every quarter, and you can go back, you're building wealth there, and then you can get back to running your business and doing what your real profession is.
Yeah, absolutely. And so it sounded like you didn't necessarily grow up loving real estate, but you developed a passion for it over time. So what was that trigger point where you said, and maybe it was the book by Donald Trump, but where
Yeah.
you really said like, okay, this is where I want to direct, you know, the rest of my career.
Well, it was interesting because I remember watching like an old Yankees game with my dad, and they were talking about one of the players, I forget who it was, back in the 90s, that bought an apartment in New York. And I was like, why is this guy living in an apartment? You know what I mean?
Yeah.
And my dad's like, well, those apartments are a lot different than the ones that, we go and visit and stuff like that. And you realize there's a whole different class of real estate rental that is, I didn't grow up in a neighborhood where people really rented homes, right? So in that area, it's not a normal thing, and you didn't know that there was nicer real estate out there, and you didn't really know exactly what's the best way of doing it. And my dad kind of was like, we should look for different properties, because I would bring properties to him when I was buying my first property. He's like, no, like you don't want that area. It's terrible. It's not terrible, but it's not what you want. And you want a quieter street. You want this and all these different things. And I was like, yeah, the prices are just going up and going up. And and it was just like, I bought the first one and it was fine. The second one I bought was a much better property. And that's the best asset I own personally. That thing never, I mean, no one, it's like just like prints money. And so the thing though is that you buy in a better area, buy a better asset. And that's what I learned over time. And not saying that you have to go and buy A-class assets. I'm not really an A-class asset investor. I feel like nicer workforce housing, C plus B minus. And I feel that opening my eyes, I think that the Trump book had nothing. I mean, there was some stuff in there about when he and his dad bought like 1,000+ unit apartments and complexes out in the Midwest and stuff that you never really heard about because it didn't have Trump on it. But how that was done, was done much more from a development standpoint, but it was a much sexier thing than what my dad was doing. So I think that kind
Mhm.
of drew me in, but then came back to home as realizing that multifamily and other commercial assets are very, very they're very consistent. And the more units you own, I was talking to an investor years ago, and he's just like, you just need more units. I was talking to him, he's like, it's like, someone pays, someone doesn't pay, all this kind of stuff. He's like, you just need more units. And it's the same
Mhm.
thing with any business. You have an insurance agency and commissions go up and down. You just need more clients. And
Yeah.
like Mark Cuban says, sales cure all. And that's the same thing, is just get more units under your belt. And if you're syndicating and maybe you invest into one syndication, 100 units and wasn't doing well, make your plan now to invest into several hundred more units, right? Because now the volatility has been dramatically reduced, because now you have so many other units. Because overall, you're going to have it. And during COVID, I mean, with all of our C class and B stuff, we had over 95% of people paying rent. And
Mhm.
if you had one bad building with all your, eggs in one basket, you might have had a different story, right? With mom and pop people now that maybe have one asset they live off of. But if you're a little bit more of a spread out investor and you're in bigger deals or in more units, whether you own 100% of them or whether you own, a tenth of a percent of those
Hmm.
units, you're consistent. Your cash flow will be much more consistent. So, and that's what that's why I invest into. For when I'm doing my numbers, it's cash on cash returns, the number one thing I look for.
Hmm. Yeah, great. And a couple things you mentioned I wanted to call out. One is, so it sounded like you were able to, sounded like your dad really instilled the fundamentals in you. He's talking about, you got to pick the right locations, you got to pick the right asset classes, wait, don't be too quick just to do a deal, right? Find the right place. That's so important. But you were also able to, you had kind of bigger ambitions, it sounded like, than kind of running mom and pop. Like you said,
Yeah.
you were exposed to where this can take you and the growth that you can have. And so you wanted to kind of take a different trajectory there. And then you mentioned something else around the idea of just like unit diversification,
Hmm.
right? And I think that's one of the big benefits of multifamily in general versus single family.
Hmm.
So I get a lot of questions around, from people that are, considering, should I do single family, multifamily, and that's one of the things that I think you hit on is, like you said, if you have more units, then you've got that diversification. It helps smooth out the ups and downs, right? Where if you have like one single family rental and it's empty, then nobody's paying the mortgage, right? You're stuck with that mortgage. If you have more units and you can handle the ups and downs, then you have that safety net, you have that coverage. And multifamily really delivers that right away, and in an individual property. But then also as you scale up to additional properties, you continue to diversify and expand that net, right?
Right. Exactly. The diversification is key with when you're building your portfolio.
Yeah. So something that you mentioned that was pretty unique is you've got a portfolio in Connecticut. Um, you've got properties in Florida. Now you're living in Florida,
Mhm.
and I think you mentioned you have properties somewhere else as well. So how are you managing all these properties remotely?
So with my properties in Connecticut, those are all 100% owned. I don't have any syndication properties up there, and I have a really good property management company up there. And when I'm remotely, it's really when if you want to go the active route and you have a small portfolio, whether that's a 20 unit building or you have 7 3 families, whatever it is. Be a little strategic when you're buying it. Try to buy them closer. It's going to make your management much easier. I mean, I can walk a half mile between all my properties in Connecticut. I strategically bought them in one section of a city, and it makes it much easier with doing management when I used to do it myself. And now when my manager does it, whether they're doing snow removal or whatever it is, they can go back between properties within minutes. And so that's one thing which makes it a lot easier. You're not being spread out with smaller properties. It's one thing if you have a 100 unit here and an hour away you have a 100 unit, you're not even going to be dealing with management. You're going to have on site there. It's a completely different thing. So that's one thing why a lot of syndicators go into a market and they can buy a 100 unit property and they already have scale because they can have 2 on site people there and maybe a part-time person to handle a lot of the maintenance requests and leasing. Now, what I did with when I was working with my property managers, and now I've got it set like a system. The first year or two, I was really figuring out working with a property manager and how it was going to work. And you start them off and you're like, hey, anything over whatever it was, a few $100s, give me a call, let me know what it is. And now it's probably like $1,000 or 1,200. I know when I get a call from the owner of the property management company, I know it's going to cost me money. And but I'll get emails and I'll get reports that come in. I have access to all the bank accounts. I'm a signer on that. Always be a signer on bank accounts with your property management company. And so I can log in and I can see when rent's being deposited. And not that I know exactly the rent amounts off the top of my head, but I can log in and see that looks like 3, that looks like 5 out of 5 have deposited there. It looks like it's, 6 over here. And when you're doing that, that makes it much easier for you, kind of an idea of what's going on, right? If you're, then there's not that much of contact I need with them in that scenario. And when we're doing larger projects now, we're going to, you're going to have somebody on the team will be kind of what we'll say like boots on the ground. Not that they're there every day or every week, but usually once a month they're going to be there reviewing the property at different times. And if maybe they're meeting with general contractors, they'll be there more often. But after a property's been stabilized, let's say renovations have been done, they're going to be checking in and seeing how the management company is managing the property. How do the hallways look? How does the yard look? We're going to be getting into any units that are turning at that point. The other thing too is that I have my property manager in Connecticut. They'll let me know every time something's vacating before it's vacating. So, and they'll also let me know when it's ready to rent. And that's just a way that I can keep kind of a little bit more control over how long it's taking. If they say it's a minor turn and it's taking 3 weeks, well, there's an issue there. Like that has to be taken care of. If they say it's a major turn and it's been done in 3 weeks, okay, fine. I mean, that's the nature of the business. It has to happen at some point. But so I think that when you're working with your property management company, your boots on the ground people there, just make sure that you can have some accountability in there of how you're going to manage. And turnover is a huge thing. It's the most expensive thing for a multifamily owner. So I feel that's something that we take care of the advertising on the unit. So when something comes up, they'll tell them, hey, this is going to be, this is vacated, should be ready in 10 days. This is the amount it's going to rent for. I tell my VA to start posting it, right? And they'll call in or they'll message in and with their phone numbers, and it's my VA will pass that to the property management company if they didn't call in directly to them. And that gives you a little bit more accountability. When it's been rented, when it's vacated. I like that. And that's just one thing there. And then also having someone, boots on the ground there too. So I can have someone that drive by the properties and, looking from the outside of a property, especially, with the snow, maybe it's a little bit more difficult, but through other seasons of the year, you can kind of see how it's being managed. And, you see if there's trash outside, you see trash cans or anything that's been moved back. You see if people have stuff outside their apartments, and it's not looking clean. These are things that the PM should be taking care of and making sure and enforcing. And this is stuff that you can do just by, a quick drive-by or having someone in the area look at your property, and you maybe pay them a set fee for that. So there's a number of different ways of doing it, but I feel that just every person has their own, how comfortable they are with their property manager. And it's not going to be the same as you doing it yourself. So you just have to realize that. And that was the first couple of years I was like, it's not being managed the correct way. And I think it took a couple years really for me to get in tune with my property manager up there. And then where we really were on the same page, where I would go up there without even any kind of introduction or let them know that I was going to be there. And I'd be like, oh, this is, again, I have my unit keys. I go into some of the hallways. I'm like, this is clean. This is fine. Everything's clean. Everything's rented out. Like, this is how it's supposed to be in some of these properties. When you're going in, I go in the basement, there's nothing leaking. There's not people's trash all these type of things that a lot of property managers that aren't on the ball you're going to go into the basement. It looks like someone moved in down there, right? With all the stuff they brought. And that's something that it just takes a lot more. Your property manager has to be more hands-on to avoid that. And I don't want to find out that I go in the basement and stuff's leaking, right? Every hot water heater is leaking and all this type of stuff. And this should be stuff that when they walk that basement and they do their own inspections, whether it's every month, they see this and they go, hey, Charles, this has to be done, right? You should be, this should be done now. And this is going to be done. Like, your roof is, it's got less than 24 months on it and stuff like that. And then those larger CapEx items, I will work. And we do the same thing when we do syndications. We'll go out to the general contractors, find them ourselves to take care of those, or the subcontractors to take care of those projects. And we might get contacts from our property manager, but we're going to be the ones that are going to make the final decision. And that's kind of how a CapEx, that's how it has to be. On turns, I don't really want to be getting, because it would just be an ongoing job for that, right?
Mm-hmm.
You don't want to be finding a general contractor for every unit turn that's just cleaning and painting. That should be in-house handyman from your property management company or from your on-site. So if that answers your question.
Yeah, no, I think you covered a lot of different things there. Definitely answers the question. It sounds like you are, you've built a system of, whether it's partners or kind of a team that's in place to help you, whether it's boots on the ground, it's folks driving by, it's keeping an eye on the property. It's, you mentioned a VA. You're going to have these different elements that you've put into place to be able to manage this portfolio that is, that is spread out, across a number of different units. And I think that's a in different
Mhm.
geographies. So I mean, it sounds like there's a great system there. Can you tell me a little bit more about that team that you've put into place and how that team, allows you to keep tabs on these properties from afar?
So when we're partnering with other groups, so if normally we have three different strategic partners that we work with, and in different parts of the country. So we have one that we work with in Florida and Georgia. We have another one that we work with in the Midwest and the Mid South. And with these groups, they have their own team. They have their own people on the ground there. And if it's something in Florida, we'll have someone from our group, right? That will be the boots on the ground, the person checking in. And I like to have how we set it up is you'll have someone that's going to be the point of contact for your group with the property manager. And then and they could be anywhere. I mean, they can be anywhere literally in the US, because they're not going to be probably the one going to the property as much. And then you're going to have people, one person at least, that's going to be the boots on the ground kind of person. They're going to be the ones that during a project management, when you're doing your capex, when you're doing your renovations, they're going to be the ones that are meeting with general contractors. They're going to be the ones that are reviewing the property. They're going to be the ones that are giving updates to the team and saying, this is coming along, and this is something that's behind. And so that's it's really those two key people once the property's been taken over by your group, what you really need to have. And I don't like to have too many people calling the property management company, because then it confuses them with who they're supposed to reach out to when there's an issue, right? They can send out reports to anyone, that doesn't really matter. But when you're talking and you're having that call, usually weekly with them with larger projects, and you want to know, did this unit get it served? Is this eviction done? Is that unit do we have possession of that unit again? You don't want them to be repeating that to three different people. So it's
Yeah.
really that having that roles up front makes it very important. And that's kind of the first question I have when someone will bring us a property. And what do you need help with? Like, where would our role be on it? Because sometimes it'll be there'll be a number of boxes that they need checked off, and sometimes it'll only be a few boxes, right? Hey, we just need someone to assist with inspections. We need someone to handle some of the property management calls and some of the reports for investors, and raising money, and a couple, signing on the debt or whatever. And sometimes it's more than that, right? Where, hey, we need someone that from your group to, would you be able to, because it's down in your neck of the woods, can we utilize your property management company there? And you can work with them directly. And then also if you had someone on the boots on the ground. So it just all depends, and that's what it's all partnering about when you're getting into these larger projects. So
Gotcha. Okay. So it sounds like you've really leveraged a series of partnerships
mm,
to grow your portfolio and be able to expand into different geographies. And you kind of have behind that your own team, which it sounds like includes your VA, which helps
mhm.
you keep tabs on things and does things like marketing. Is that right?
Yeah, I have a couple different VAs. I have one that takes care of a lot of admin stuff, and that's where that comes in. So they're posting different apartments for us. Usually when we're getting into the larger syndications, it's usually a property management company that's handling a lot of that marketing. I kind of keep an eye on that to see exactly how much traffic we're getting for potential renters coming in, and then you can kind of tweak that. And then that way you kind of know what the issue is. If you're having issues renting, is it just because the size of the units or the unit mix, whatever it might be, or is it because you're not getting enough traffic or eyes on the property, right? And then that's something that we can fix. We can turn up the marketing on it. We can pay money to have that done. And some properties have so much people that walk into it, we don't even have to deal with that, right? So, and we have one property that we have more people that walk into the property than we have units on it every month. So it's like, it's just certain areas just have lots of traffic depending on where it's located. So that's something that's least of our worries, is getting people there. What we need though is that we need to have the units turn fast. And so when people, our waiting list, we can actually serve those people by renting to them.
Gotcha. So you mentioned kind of watching symmetrics and knowing when to turn up the dial from a marketing standpoint. I mean, what are the what are the benchmarks that you're looking at? I mean, what are you expecting to see for a unit that you've listed, and what tells you that it's time to turn up the dial?
So well, you'll talk to your management, and sometimes they'll be like, especially when you're in C class, and hey, we're getting a lot of people coming in, we're getting a lot of applications, it's just not qualified. Okay, so at that point, that's probably a lot of walk-in traffic. So what we're going to do there is there's a lot of different online services that will put them all on like Zillow and apartments.com and all this stuff. And you can really cover a number of different platforms. I forget the name of the service. It does like 20 different apartments.com type websites. And you can do it there. We will post as well on Craigslist. Most of the time for my own properties, posting on Craigslist will get them rented. If something hasn't rented or we don't have it rented within like a week or two, we'll put it on Zillow. And it'll be, I mean, it'll go real quick at that point. So sometimes we'll just do it both at the same time. It just depends on certain unit sizes rent faster than others, depending on the market you're in. And knowing that, like where we are in Tampa, 2 bedrooms go off the shelf. Like we can't, we have 100% occupancy on 2 bedroom units, right? And on 1 bedrooms is a little difficult. So that's something where we're going to have to put that out, and that's going to be where we're going to it's going to take more marketing kind of know-how to get those people into those apartments and turn down from, say, you know, maybe 2 weeks after you finished it renting it to maybe we'll be happy if we can get it rented within 3 weeks or 4 weeks to someone that's a very qualified person. So just having those metrics in line, in check, and sometimes it goes faster. It really depends on how you're kind of together with it. But when you're getting more units, you don't really have to turn off the marketing, which is great. On smaller properties, when you have unique units, you have to keep on turning on and turning off. But when we're doing in syndications, we can now say, yeah, we have like 170, 180 units in Tampa. And we can say, well, we don't have anything here, but 3 blocks away, we have another property. And it's going to be similar rents, blah, blah, blah. And so now you have that competitive advantage where other operators there aren't able to fill their units from another property, right? They only have their property that they're able to fill units from. And so having more units in the area too is something that helps out and really ups that competitive advantage, which really, when you're buying real estate, it's relationships and money. If you have access to capital and you have long-term relationships, right? That's where you're going to have advantage over other buyers. But when you're on the rental managing side of it, you have that competitive advantage when you have more units, right? Scale of economy, so you can get your costs down, but also you're able to keep your vacancies at a lower amount because you have much more sources for getting renters in and then moving them. Somebody wants to go from a 1 to a 2 bedroom, instead of them getting back on Zillow, now you're like, hey, we don't have any here, but we have one here. And right off the bat, you've minimized the leasing fees, you minimize all these different fees that you might have to pay if you had to kind of obtain that client again, and you already know that the tenant's a good tenant. So that it's minimizes risk across the whole board.
Mm-hmm. Yeah. So it sounds like general strategy is you're acquiring several properties in a single location, and then you're able to kind of cross market or cross refer. And in that way, keep all your properties full. So a very good strategy. You know, what is it as you look at Harborside and your strategy that you guys are executing, what is it that differentiates you from the host of other syndicators?
I think that it's the experience. I mean, I've been investing in multifamily since 2006, like we were talking about. A lot of the operators that we'll work with, they'll have some of their seasoned people on their teams that have been investing 20 plus years. So you have a lot more experience. And I feel that when you're partnering with other operators, I really want to see people that are making decisions in our partner companies that have gone through the downturn, right? 2008.
Mm-hmm.
And obviously we all went through COVID and going through it still, but it's something that when you're going through a pullback like that, if you've gone through multiple pullbacks, you kind of have an idea of what to expect. And obviously everyone's different, right? So you can't compare 2008 to the early 90s to COVID, right? But it's something that you've understood an area where a time when you're not raising rents and you're not sticking to your business plan like you wanted to, right? Raising rents so soon and doing all this work to the property, you've got to really figure out a way of increasing your net operating income on current assets and new assets by not raising rent. It's like the old adage when you're selling your house, hey, what else? You talk to your real estate agent. Hey, what else do you have up your sleeve other than lowering the price of my property? Sell it, right? And so what else do you have up your sleeve to increase NOI other than just raising rents, because raising rents doesn't work in every market, as we saw last year in COVID, right? I guarantee most operators out there, if they're being honest, didn't raise their rents as much as they wanted to. And they didn't do the CapEx work that they really wanted to complete during that year. And the safe thing to do is put that on pause and do rent increases as the market will bear. But the thing though is that, what else were you doing? What inefficiencies were you taking care of? When we were buying a property, we bought a property and our last property we bought was a 90 unit and it was in Tampa, and a 68 and a 22. And we put it together in one syndication about 2 blocks from each other. The 68 was a much more stabilized property. The 22, it was mom and pop, and it was, we now, painted them, and they're now like in part of the whole asset that we have in the whole area. But the thing though is that they're paying a 15% management fee. And we bought this during the summer of COVID, really, end of summer of COVID. So the thing though is that, with that being said, we can plug that in, and it's just over 3% with our property manager in Tampa. So with that being said, without us doing anything, we now have lowered management by 80%. So it's something that that's a way of adding value to a property without going in there. Like every renter thinks you're going to do is, raise their rent $100 without doing anything. And that's kind of what separates, I think, seasoned operators from maybe less, I guess, I don't want to say newbie, but newer investors, newer operators that might not know how to handle a downturn, because it's easy to make money when the market's going up, right?
Sure. Yeah. So you're saying really an understanding experience, but I think what you're saying is really what that means is an understanding of what all the levers are, right? And which levers you can pull when, to have multiple ways to add value, not just rent, but focusing on economies of scale and expenses, right? Which you mentioned from that management fee example.
Right. Exactly.
Yeah. Well, very good. Well, I'd like to go to the keys to success section. We've got a few questions I want to ask you, Charles. First one is, what's the one question that every investor should be asking their sponsor?
What is your experience with this asset class in this market? I think that'd be the main thing that I would ask, and see what that response is, and make sure that it suffices.
What type of response would you be hoping to hear?
I would want to see that they've had experience, obviously, in that asset class and in that market. And I want to make sure the property manager, because they're the ones that are really pulling the levers, like you say. They're the ones that are really running the property. You might have a $10 million asset, but let's be honest, the person that's actually seeing your tenants every morning is making $40,000 or $50,000 a year. So how are they finding that person, that key person, to keeping someone from 12 months to 24 months, right? Or from 18 months to 36 months, and minimizing your turnover. And that's kind of what I want to see. What is the property management's kind of experience as well in the market with doing what your business plan is. If your business plan is it's already a stabilized property and we're just holding on to it, great. Like, what other assets have you done? Or have you done these major 5,000 plus per unit CapEx projects? And what are the addresses? And that's the kind of thing I want to look at as well. So you're vetting not just the sponsor and the operator, you're vetting also the property manager.
Yeah, really good point. Thanks for following up on that. And what are you most proud of in your career?
I think my first commercial property, I bought a completely vacant. It's every time I think back on it, it's completely nuts. Mixed use property. So it had like small commercial downstairs, and it had a bunch of apartments above, and I still own it. But I bought it 0% occupancy. It was during the end of 2009, and that was when I think this thing was sitting on the market. I actually found it through a residential broker, and that thing was like, man, it was like on the market for like 5 months. I put in like an offer like 30% less, and they like countered, and I think countered for like 2% higher than what my offer was. And I bought it, and I refinanced it out after getting it fully occupied in like 90 days. And doing a major renovation on it. And that was my first. I didn't even know what value add was at the time. I was just turning around a property, and I didn't know they had all these. I didn't know house hacking was a thing too, and I was already doing that. And so that was kind of my that really. When I did that, I was like, I could take on a lot bigger projects, because I mean, it was a lot of risk, and no investor money. It was 100% my money. I paid cash for it, and did all the renovations in cash. So that's what I would say is my most shining moment so far.
So a ton of experience coming out of that one property, it sounds like.
Yeah.
Would you do that deal again?
At the price. Oh yeah. I remember I finished it with it. And my broker was like, now you just need 5 more of these or 4 more of these. I was like, exactly. Right. And that was the beginning of 2010. So like that was one thing. When you're buying property, don't always look for a home run. That was a home run. That was like a grand slam. And my property manager still can't believe what I bought it for when I was having man. She asked me what I paid for it, and he was looking. He's like, "Oh my god, he stole that." And so I stopped like looking at properties like around 2011, 2012. I was like, oh, it's way overpriced, right? Because you're so used to buying in 2008, 2009, 2010.
Right.
And then you're like, so look for, it's fine to do doubles and triples and singles, right? It's always be looking for properties. And I think that's, if you're active, that's the thing that you have to do. Not every property is going to be home run, but you will hit them, right?
Yep.
But so just, that's one thing I would like to tell your listeners as well.
Yeah, I appreciate that, because I use that baseball analogy a lot. I tell people, like, look, we're not hitting home runs here, because what we do, the value add, B class, right? Cash flowing properties. We say, look, we're hitting singles and doubles, but we're staying on base, right? And you keep going around the bases, and the runs add up. So yeah, I appreciate the baseball analogy. What book should everybody be reading?
I love there's two 80/20 books. There's an 80/20, the main one, and then there's an 80/20 marketing one. And I think anybody self-employed, I think the 80/20 one for anybody, doesn't matter if you have a job, whatever you do, you should do that. Read that book. And it's a quick read, right? If you were flying, you could read on one flight. And the 80/20 marketing is about the same size, and it just breaks down, if you're in sales, where you're spending your time, and if you're in your business, what are the high level activities you're doing, and which ones should you just get off your plate one way or another. So definitely 80/20 series.
Cool. Thanks for telling us. And then lastly, what is your number one key to success?
When I started like focusing more on what my goals were, and really outlining what my 5, 10, and 15-year goals are, and then kind of brought that to figuring out weekly what my goal has to be. And that's something that you can really track. It's very difficult to see if you're on track with a 15-year goal, right? But you should have them, right? But it's something where I can now break that down to a 1 week goal. And I know, okay, this is what I have to do this week to move myself forward. And usually it's not something major. I mean, it could be something a few hours a week, an hour a day that you time block out. And you look back in 2 months, you're like, oh my God, I've really made some progress. And that's something over the last 2 years I've done. And it's dramatic. I mean, it's amazing the amount of progress you can make by consistently doing a little bit every day in the same direction.
Yeah, I think that's so powerful, that you take these big kind of analogous goals that are out there, and break those down into something very specific, and specific actions you can take daily and weekly, right?
Right.
And I think, like you said, like something that I do, where I've got 3 small kids, we've got a new dog right now, we've got a lot going on. I don't have a ton of like large chunks of time, but what I can do is I can chunk out 15 minutes a day to read, as much as I can in that time. And um some days it's a page, some days it's more, but at least I'm making progress, and I'm able to read books that way. Because if I waited until I had an hour or two to sit down and like really dig in, like it just wouldn't happen. So I found that even being able to just chunk out a little bit each day, even 15 minutes, can make a difference.
Yeah, the 10 pages a day, that's kind of the goal I try to hit. And I don't hit it every day,
Hmm.
but you do it and you look back and you're like, oh, I'm almost done with this book. And you
Yeah.
think 10 pages is nothing, but you can do a book a month. I mean, that's a lot better than most people don't even read a book a year. So,
Right. It's like, yeah, no, I'm going to get to that book. And then it just sits there and collects
yeah.
dust. Exactly. Well, awesome, Charles. Well, thank you for coming on the show today. Thank you for sharing your life story, and your journey, and the information. I think a lot of good content for folks today. If people want to get in touch with you and learn more, how do they reach out to you?
So if you're interested in passively or actively investing, I do free 30-minute strategy calls, and we can kind of talk about where you are now and where you want to go. And you can just go to schedulecharles.com. So it's schedulecharles.com, and it goes to a page right on my personal website. So you'll have all my other information there as well. And you can just book a time, and we'll talk about your 5, 10, and 15-year goals.
Awesome. Well, very good. Well, everybody reach out to Charles. Thanks, Charles. Have a great rest of the day, man.
Thanks, Kent. Thanks for having me on.
Bye.